Taxes. Picture this: you've just had a hard month at work, flipping burgers at your local McDonald's. You're in bed when you get an email saying you've been paid $2,000, but your bank account only shows $1,456. You scroll down the pay stub. Federal income tax. State tax. Social Security. Medicare. This is the modern ritual of giving away a chunk of your money to invisible forces, and they expect you to say thank you. Here's the truth: taxes are the cost of civilization. You pay, and the government builds roads, funds schools, checks if your favorite taco truck isn't infested with rats, and sends billion-dollar missiles to places you've never heard of. There are different types of taxes. Income tax hits the money you make. Sales tax hits the money you spend. Capital gains tax hits the money your investments make while you're asleep. Almost everyone also pays Social Security tax and Medicare tax. Social Security is basically forced retirement savings, money you get back later. Medicare is a health insurance tax for elderly people and those with serious conditions. Then comes filing your taxes. The government already knows how much you owe, but makes you guess. If you're right, cool. If you're wrong, you're cooked. Some people pay taxes quarterly, some yearly, and some don't pay at all and end up starring in documentaries. Taxes are annoying, sure. But countries with higher taxes usually have a higher quality of life overall. Banks. You walk into a bank, hand over your money, they smile and say it will be added to your account. You walk out thinking it's now sitting safely in a giant vault guarded by a dragon. In reality, that money's already gone. Most people think banks just store your money, but they're really middlemen for financial transactions. When you deposit $1,000, the bank keeps a small portion and lends the rest, maybe to someone who wants a jet ski. This system is called fractional reserve banking. It works because they assume not everyone will withdraw all their money at the same time, unless it's 2008, of course. Banks make money by lending your money at a higher interest rate than the interest they pay you. You're the supply of money, borrowers are the demand. They encourage you to deposit money because it's easier to use a card than carry cash. They pay you interest. It's safer. In the US, deposits up to $250,000 are insured by the government. Interest, the cost of borrowing and the reward of saving. Borrowing money or the reward for saving it. Borrowing: if you borrow money, you pay interest as a fee for using someone else's funds. Saving/investing: if you lend money or deposit it in an interest-bearing account, you earn interest as a reward for patience. There are two main types. Simple interest, a fixed percentage of the principal. Compound interest, interest that earns interest, growing faster over time. The bad side is credit card debt snowballs quickly. But the good side is investments compound over decades into huge gains. So if you're paying interest, kill it fast. If you're earning interest, let it grow. Inflation: why your money is losing value. Inflation is when your money loses value over time as prices go up. For example, $10 a year ago might have bought you a liter of milk. Now that same $10 might only get you 750 milliliters, you have to pay more for the same thing. Why does this happen? There's too much money floating around compared to the stuff people want to buy. Supply chain problems make things more expensive to produce. Sometimes it's just psychology. If people think prices will rise, they spend more now, which pushes prices up even faster. A little inflation, like around 2% a year, is normal. But if it spikes, your savings lose value and wages often lag behind. To cool things down, governments or central banks may raise interest rates, making loans more expensive so people spend less and the economy slows a bit. Recessions: what they are and how governments respond. A recession is when the economy shrinks for 6 months or more. Jobs vanish, companies cut costs, and people only buy necessities. Causes: high interest rates, global crises, war, pandemics, natural boom-bust cycles. Recessions are painful, but they are part of an economic reset. Governments often respond with policies to encourage spending and investment, helping the economy recover over time. Credit scores: what affects your credit score and how to improve it. A credit score is a number that shows how trustworthy you are when borrowing money. Lots of countries use them, but systems vary. What affects your score? Payment history: do you pay on time? Biggest factor. Credit utilization, how much of your available credit are you using? Length of credit history, longer is better. Credit mix, different types of credit help. Recent applications, too many new accounts can lower your score. A good credit score doesn't mean you're rich, it means lenders trust you, which makes it easier to get loans, mortgages, or good interest rates. Investing, how to make your money work for you. Investing is getting your money to work for you instead of doing nothing. Common ways people invest. Stocks, own part of a company. Bonds, lend money and earn interest. Funds, a mix of stocks and bonds without picking each one. Real estate, buy property to rent or sell. Investing has risks, but it's one of the best ways to fight inflation and grow wealth. The key is patience, diversification, and time. The earlier you start, the more your money grows due to compound growth. Value, why perception creates value in the market. Value is what people believe something is worth. A shiny rock, gold, is valued more than a normal rock because humans say so. The richest people create or provide value. Steve Jobs made the iPhone. Doctors save lives. Luxury brands sell status. If people perceive something as valuable, then it is.